Fleet ultimately merged with Bank Boston, and how did you survive that?
Well, that was the last deal I did. I was the head of M&A and strategy, and Terry Murray and Chad Gifford put together that deal, and Chad took a liking to me. I was an acquired.
Chad Gifford, who was the head of Bank Boston.
I was acquired taste for Chad because I was in the middle of negotiating, getting all the cost structure and getting the alignment, and I was meant to be the pain in the butt. And so Chad ultimately took a liking to me as a great mentor and said, "You got to run a business," and put me in running a business. And we were merging two companies together, and I survived and ran the wealth management business for a few years.
You ran the wealth management business for the combined Bank Boston Fleet.
Yep.
And then Bank Boston Fleet combined company was sold to Bank of America.
In 2003 fall, yeah.
And so how did you survive that one?
Well, they asked me to run the wealth management business, the combined companies, and I did that. And Ken Lewis wanted to integrate some of the people, because the companies were maybe 60-40, but they're very sizable companies. And so he was trying to get a management team that represented both companies. And so Chad was chair, and Ken was CEO, and I went and ran the wealth management business of the combined company.
All right. But then you became the general counsel.
For 40 days.
For how long?
40 days and 40 nights.
All right, so you became the general counsel of the combined Bank of America.
Yeah.
And then?
Well, so what happened was, in December of 2008, remember we bought Merrill on the Lehman weekend and everything, so we were originally trying to buy Lehman. We said we couldn't do it as a company. I was running at that point the corporate investment bank and other parts of Bank of America. We couldn't do that. And then over the weekend, that's when the world became very ugly. And so we bought Merrill, and remember Morgan Stanley got investment from the Japanese bank, and investments were made around. And so after that, I'm sort of running the integration, a bunch of stuff as we're going through from October or whatever it was till the fall. And then around the time Merrill showed up with a $7 billion loss in the quarter, and with a lot less capital than we're supposed to have, we started telling the government we couldn't do the deal and stuff. And so Ken asked me to be general counsel because we were eliminating a lot of jobs, and I actually eliminated my job. And I was basically out of the company. He said, "You know what, stay and become general counsel because we need somebody." And from December 9th to
All right, so you became the general counsel of the combined Bank of America.
As we negotiated with the government to figure out how to get the Merrill deal done, and then I went back in business right after.
But then you left after that for a while.
No, I became. So then in mid-January of 2009, I took over a bunch of the businesses after John Thain left and went back into business. And then by the end of 2009, I'm CEO. I had a lot of jobs in a short period of time.
All right, so now...
It wasn't what somebody should do.
Now, you bought Merrill Lynch at a discount, I guess, or low price, but it turned out to be a pretty good deal, I guess, right?
From an operating basis, it was always a good deal. The issue was that the hole in their capital cost us some dilution. So, and we worked through that over time. So, with new capital rules and everything, we had about 7.5, 8 billion shares at the time. We went up to almost 12 billion. Now we're down to about 7.4. So we're back down to where we should have been. But it took a lot of work through all. But from an operating basis, it was always a home run.
Right, before your bank came back from a rough position, you borrowed, in effect, $5 billion from Warren Buffett. Is that right? More or less?
Yeah.
And it was pretty expensive capital, some people say. So did Warren Buffett get a better deal? Did the Bank of America get a better deal out of that?
Well, our stock was trading at $5. He converted at $7.14 a share. So it was a class of 20%. He had a 6% dividend. We were paying low dividend. But if you bought the common or the preferred had a 10% dividend that day. The common, you would have done better because you would have picked up more the first $2. So you picked up. So
did you negotiate the deal with Warren Buffett, or is he pretty smart? Or?
It's apocryphal. He's told the story, so it's not my. But the idea came to him in the bathtub. He called up, got into the call center, believe it or not. Right. Then finally got someone to get a number, called me and said, "I want to put $5 billion in your bank." And I said, "We don't need the capital, Warren." He said, "No, you don't. That's why I'm calling you. You need stability, and I can provide stability." And I said, "Yes, you can." the night before, a fellow named Mike Lyons, who now runs Pfizer, who was working for us at the time, and a fellow named Bruce Thompson and I were sitting there saying, we need to get some stability, because remember, what people think about is government shutdowns and defaults. The government was really in trouble in August of 2011. They couldn't come together in funding. They were starting to overdraft their accounts, let's just call it that. So that was going on, and then we were getting banged around because all the mortgage litigation. And so he came in, put the money in, and from then, from basically $5 share price up to $44, $45, whatever, it's been pretty unbroken since then. So he's fared well, and we fared well.
Does he still have the stock, or has he sold most of it?
He sold about a third of it, and then he bought another 300 million shares. He ended up with 1 billion shares. He sold down to like 600 last I know, but he did very well, and we did very well, and he's been a great investor.
Let's talk about the beginning of Bank of America. So Bank of America started as Bank of Italy.
Yeah.
So who started Bank of America, and why did he name it after Italy as opposed to America?
Well, A.P. Giannini, who was Italian descent, started the Bank of Italy when he came to the country in San Francisco to help the Italian community that emigrated to San Francisco. And he became famous in the San Francisco earthquakes and fires in the early 1900s by setting up a barrel and starting to lend money. And then fast forward to 1999, when Nations Bank, which was the North Carolina Bank, which is the bank, the bank today, and the Bank of America merged, you had two good names. Nation Bank wasn't a bad name, but Bank of America was a better name. So they took the name, but the operating company that survived was Nations Bank.
So it moved from San Francisco headquarters to a Charlotte headquarters, where you are headquartered now.
Yeah. And it's interesting, because with the LA fires, we've asked our teammate Raul and I to step in, because we have a heritage in California helping in times of stress. That we have a big business in California, and Raul's doing a great job. But you do have this historical ways that we've done business around the world. We're the first bank to make a loan in Japan after World War II ended, at the request of the U.S. government to start lending money. We've been in UAE since it was formed. So you go back in heritage, it's just a wonderful heritage. And the Bank of Italy heritage is apocryphal because of Giannini. But the reality is the bank that survived all this and drove all this was the North Carolina Bank, which formed to bring capital to the Southeast as it grew, because the New York bankers wouldn't come down and do as much business. That is the bank that survived all this. And so all these rivers came together and formed this huge river.
One of your predecessors as the head of Bank of America became the head of the World Bank at one point. You have any interest in being the head of the World Bank?
No, you've got Ajay coming in. I'll let him run that, because I haven't been asked, and he does a great job. He'll be terrific for it.
So let me ask you about this. Banking today, why do we need all these bank facilities, bank
branches,
buildings?
Financial centers.
Because everything is done online, it seems. Do you actually have a lot of buildings? Do you really need all those buildings you have where you have your bank?
This is the classic do as I do, not as I say. Because at the end of the day, between this morning when the banks open up to tomorrow morning, 400,000 people come into our branches. So this idea that nobody goes to a bank branch just is not true. The idea that nobody uses cash, we'll have about $250 million and we'll go out of our ATM machines in the next 24 hours. The idea that nobody writes checks, there are 100 million checks.
How many banks do you have around the country now?
We have 3,700. We went from 6,000 down to 3,730.
And what about ATMs? You have a lot of them?
We have about 14,000 of them. At the high point, we had 18,000. And that's technology. At the end of the day, the huge technology impact in banking over a long period of time, but since the team started in 2010 coming together, really started a few years before that, we have been basically engineering the head count, the facilities. We had 120 million square feet of real estate in 2010. We have about 70 million today.
Hey, now, have you ever gone to get money out of an ATM and been denied?
Not since college during the Great Blizzard of '78, when we were at the wrong. A friend gave us an ATM card to go out and get some money to buy liquor before everything shut down, and we went to the wrong bank.
What about
give us some money?
What about credit cards? You ever had your credit card denied?
Not that I'm aware of, but
so
hopefully nobody else has that shouldn't have been either.
How has the world of technology affected the banking world? So right now, so-called fintech. Has fintech dramatically changed the way Bank of America operates?
So we invest about $4 billion in new code every year. Every weekend, we'll have a couple million lines of code go in to amend our systems and change our systems or add new technology. That's not to run the systems. That's another $8 or $9 billion. That is just new activity. So the impacts have been unbelievable. But people it's still human beings and what they do and how they do it. So you have to be high touch and high tech. So in the mid-90s, when I was the head of strategy for the company, I remember consultants coming and saying, 20 years there'll be no bank branches. Well, it's 30 years, and guess what? We still have 3,700 and stuff. The reality is people want it all the ways. So, but the impact of the phone, the iPhone in particular, was so different. And we were the first app available on the iPhone. And the reason why is we built our technology through someone's prescience in the company to be a web-based technology, back when people didn't do that. It was really an app-based technology. So it could be made an app back. We don't think of these things today, but back then that was an unusual thing to have an app. Everybody went to the websites, et cetera. So that took off. And so from that start, you now have 40 million consumers who bank digitally with us all the time. Last year we had about 90+% of our interactions with consumers are digital. Right. And yet the critical importance of a person going into one of our stores and saying, I got to figure out how to save more money. Can you help me do a financial plan? My mother's sick. I've got a power of attorney. I need you to figure out how I can manage her affairs. My kid wants to go to college. I need to figure out how to borrow the money. All those things are critically important. So you have to be able to do both.
So people still writing checks the way they did 10, 20, 30 years ago? Is that a big business for you, check cashing?
Check cashing is not a business. It's a convenience for the customer. The checks written from like 2019 and now are probably down 30 or 40%. There's still a fair amount of them. What you've seen is the dollar volume written stays flat, right, but the number written comes down. And we track that literally every week, but we track all our spending every week, but we can see what's going on in the American consumer. But in the dynamic there is people are still paying their rent or the mortgage or something like that, car payment with it. What they've done with Zelle, which didn't exist a decade ago and now is the dominant force. Our clients send more money over Zelle than total Venmo is sent, to give you a sense. And so it's become the dominant way. That's replaced a lot of small dollar checks, but the big dollar checks still go through the system.
In the old days, when I used to write a check, the bank eventually would send me back the canceled check. What happened to those canceled checks? Where do you keep them all now?
They're all document destruction policies, but they're all image-based. So even if you went to a branch and deposit a check, it's image-based right then, the actual check's destroyed. Right. The idea of taking a check deposit ATM, so about 15% of the bank's checks are deposited at the physical ATM, a lot of small business activity. The other, let's call it 85%, about 50% of it goes through mobile, taking a picture of it, which is you imaging the check. The other 30% goes through the ATMs, which the ATM takes a picture of the check. The check disappears in all cases.
So if I want to go to use an ATM and I have a Bank of America ATM card, but I don't see any Bank of America ATMs, I go to some other bank ATM, I pay a fee.
You wouldn't, David, because you're...
What?
You wouldn't, but other people might.
I thought you had to pay a fee. I mean, is that a profit center for banks, those fees? Or?
No. At the end of the day, we get 55% of our revenue, our $100 billion of revenue last year, 55% came from interest, 45% came from fees. The dominant part of those fees are trading revenue and asset management fees and things like that. We have consumer fees, but they've come down dramatically because basically we said to the consumer is, you keep changing your behavior, we keep driving down the cost to serve, and we'll give that back by lower and lower fee structure. So we have a no-fee checking account. We have a $5 simple checking account that people know that you can't overdraft. We do our overdraft fees when we first started changing our policies 15 years ago were $5 billion a year, and now they're $120 million a year.
Do you think we will have in our collective lifetime no more currency, everything will be digital, or you think that's not likely?
Not in our lifetime.
What about a digital currency, which doesn't preclude other things, but a digital currency?
Well, I think the new administration wants to push, so you have to think about three parts of this dialogue. There's a blockchain question, There's the stable coin type of currency question, and then there's the Bitcoin and other types of things. It's pretty clear there's going to be a stable coin, which is going to be a fully dollar-backed, type of thing, which is no different than a money market fund with check access, is no different than a bank account, really. And so, if they make that legal, we'll go into that business. So you'll have a Bank of America coin and a U.S. dollar deposit, and we'll be able to move them back and forth because now it hasn't been legal for us to do it, but it's just then like another foreign currency.
Okay.
The question of what it's useful for is going to be interesting.
Right. So in the old days, 10, 20, 30 years ago, if you had a lot of coins, you put them in a jar or your desk, and eventually you could wrap them up and take them to the bank. Now, if you go to the bank, they don't want the coins.
Well,
What do you do with these coins now?
we're going to get rid of the pennies, so maybe. The end of the day, if you roll them and bring them in, they'll count them up and stuff. But it's a tricky thing because it's just a lot of work for.
Okay. So now President Trump said we're not going to make the penny anymore.
We'll take all your coins. Don't worry.
Okay. The penny. What about the penny? We're not making the penny. Is that a problem?
I think the economics that they're talking about is it costs more to distribute them. Look, at the end of the day, when you think about the bills, the currency, whether it's coin or bills, and it's mostly bills in terms of value. It's an interesting thing. So 98% of all the bills that move around the world, we move on a day as a service to the government. Right. And there's nothing bigger than 100. So $1 billion of hundreds weighs a few tons. $1 million of hundreds is a 25-foot stack. So there's a big physical part of this. Now, the reality is that's done for reserve currency and central banks. That's who holds it. The rest of the money all moves digitally today. So we'll move $3 trillion today digitally. So the idea, and our consumers' money movement is dominated digitally, whether it's a Zelle payment, a wire, an ACH. At the end of the day, that doesn't include credit and debit cards, which would take another big part because at the end of the day, what's a debit card? It's just an introduction to digital. So getting rid of pennies and stuff, there's economic support, but the reality is we'll always have currency because that represents.
And what's the most common currency? Is it a $100 bill or the $1 bill?
I don't know that, but I'm sure there's more ones than hundreds. But at the end of the day, all the big, the real money movement to the central banks is all the hundreds. It's palleted to hundreds. It's a wild scene to watch, pallets go through this. We go to the Federal Reserve, we pick up these pallets of cash and send them around to the central bank of, France to have their reserves. Well,
when you need cash, do you go to the bank and get cash at the end of the week, or do you just go to the ATM, or you don't use cash so much?
I do everything every one of our clients does. Look, at the end of the day, I often go and say hi to the teammates because that's kind of fun. So I try. If the bank's open, I'll go and say hello and get some money out. But at the end of the day, like you, like me, like everybody, you become. If you look at the way the money. So year to date, about 7% more money got moved by Bank of America consumers over last year. So that's pretty healthy. If you look, 25% went by credit card payments. And about 14% went by checks and Zelle and other stuff. Cash was probably in the high single digits. So it's not a lot of cash goes out of the ATMs every day when you put it against these other payments. So $4.5 trillion will go out in cash. How the ATM today is a couple $100 million, and that's going in an economy being spent. So the healthy consumer spends money, and that's good, but they use all the devices. Cash is becoming less, but it's still critically important. And so that's why you have ATMs, and that's why you have branches, and that's small businesses receive cash especially and bring it in deposit, and that's why you need a physical plan.
So if I go to your bank and I want to make a deposit of $10,000 in cash, I'm going to get reported to the federal government.
Yes.
And 10,000 isn't what it used to be.
So one of the reforms we're saying is, and somebody testified a few weeks ago to this fact, so I'm paraphrasing their story. Is they said when 1972 they set the $10,000 level. The theory even goes back to the 40s, but let's just say 1972. In 1972, you could buy a fully loaded Cadillac for $10,000. We're now this many years later, and we still report not only if you did 10,000, but if you did 3 or 4 transactions in a period of time that looked like you were trying to evade the 10,000, we'd have to report that too. One of the simple answers we're saying, just index that to where it should be, which would be like 100,000. When you do that, that takes out all this activity. It moves it away. And $100,000 is the inflation-adjusted amount from 50 years ago for 10, or maybe 78 or 80,000. And so if you're saying lift that amount, you'll take the average transactor completely off the table, and you really will be looking for people who are trying to move significant amounts of money or avoid the transaction level. It's such a simple fix, and I think people can see that. And by the way, in 20 or 22, there was an act passed that became law that gave the authority to Treasury to do that. They just need to do it now.
Right. So now you live in the Boston area, as you have for many, many years. The main, biggest headquarters office I think you have, or financial center office, is in New York, and your headquarters is in Charlotte.
Yeah.
So is that inconvenient for you to go all these different places?
No, it's not, because we also travel all over. Like, I'm here today, I'll be in Florida for a couple of days, and et cetera. So we move all over as executives in big companies, and you do too. But the idea of moving people around and moving their, where they work and moving their families, it's more difficult than 20 years ago when we said we're moving the headquarters to Boston 30 years ago. You just got to move. Right. It was not a question that you said, oh, maybe I got a better idea. So as we look across that, we have 16,000 plus people in Charlotte. We have about the same amount when you take New York and the areas around New York. But we also have 5,000 people in Boston. Around there we have 35,000 to 40,000 people in the state of California. We have 25,000, 30,000 people in Texas. So Florida, we have operation centers in Jacksonville. So you have people everywhere. And the idea is we try to always look at it and level load activity around the country to avoid, to use time zone differences to our advantage for call centers and to access talent pools. And then remember, all our branches and our private banking teammates, our Merrill teammates, and our business lending teammates across all the businesses, they're all in the field. They're in 9,700 markets out there every day.
So if I wanted to buy, make an investment in a bank stock, would you say it's a good idea to invest in bank stocks now, or you think bank stocks may be overvalued, or what do you think?
Our valuation difference to the S&P is lower than it's been, and I think our company is a great value, and the rest of the banks are pretty good value.
Okay, so now, when you took over the bank, you had more employees than you have today. The bank has expanded. Why do you have fewer employees? Because your bank's so much bigger. So
that's technology, and that's applied technology. So in 2010, we opened with 284,000 employees. We went up to 305,000 at the peak, and we ran as low as 204,000. Now we're about 213,000. And so all that was done with applied technology and digitization, new technologies, both. So if you think about work, the way to get rid of work is to eliminate and re-engineer the work and eliminate steps and things like that. You can do that through automation. You can do that through just not doing them, et cetera. Avoid duplication. Then you can eliminate management of work, because if you have less people, you need less managers. And then you eliminate the real estate that people sit in. And so we've been doing that on and on again. But the key to make it really move was technology. Right. And so whereas we had, in 2010, we would have had 5,500 branches. We now have 3,700 branches. We actually have probably almost 1,000 of those in places we did not have branches back then, in different cities. And so if you think about maybe 600 or 700 like that, so you think about that, those branches are bigger and more efficient, but all the transactions that come out, right, and what's in there is sales activity and relationship activity. And so it's just that constant re-engineering. We have this thing called OpEx. Every year we come up with thousands of ideas to take out and re-engineer the company. And so at the end of the day, more customers, more activity, more people, and yet you've driven the head count down, and our costs are 2/3 people. And then basically the other third is some advertising, the buildings, and some technology and electricity.
Now, there's an acronym today that some people in Washington don't like called DEI.
Yeah.
Do you have a DEI policy or not anymore?
We have diversity and inclusion in our company, but let's step back. What we've always been is a bank of opportunity. So we think about creating an opportunity for our teammates. And how do we do that? We go out and hire from all areas and bring people into our company. So we go to 400 different schools to recruit kids. We have a program we call Pathways. So Pathways we announced in 2018. We said we'd hire 10,000 people from low and moderate income neighborhoods to come work in our company. We completed the first 10,000. Then we went out and said, we'll do another 10,000. We're up to 30,000 people over the last decade almost that we've hired from LMI communities to come work for our company, from high school, junior college, and colleges to come work. So once we have a very diverse company in terms of representation from all economic stratas, all races, all ethnicities, once they get in, the opportunity is there of a lifetime. We equal pay for equal work, the ability to promote, we train, we do all the work. And so the idea is that's an opportunity. When we look outside our company, we try to work with other employers to create the same opportunity we create. We try to work with nonprofits and communities to create opportunity for them to be successful. And so the idea is just create opportunity. So we have a diverse team. We stress inclusion. So when you're at our company, you can be who you want to be and be successful, including we have 300,000 memberships in our employee resource groups, of which about 60% of the people are in one. The average S&P 500 company has 5% employees. Our employees love to work together. They're open to all, even though a cohort. And so we just try to create opportunity.
So a young person who's graduating from college, why should they go into the banking profession as opposed to private equity, investment banking, healthcare? What's the appeal of working in a bank?
Well, when we bring the 2,000 kids in and I talk to them, I always say the same thing. You can make a lot of money doing a lot of things. You can have a great career doing a lot of things. But if you're going to come to our company, you really want to help people. You want to provide the answer. Our market position is, what would you like the power to do? And I said, your job at this company is to help people answer that question, whether it's a customer, whether it's a teammate, whether it's a shareholder, whether it's a community. And you got to come and want to do that. You want to deliver a lot of profits done the right way with a purpose around it. And if that's what makes a place special, and our turnover rate's an all-time low, and we are sought after by young kids to work. So you hear everybody's going to tech companies and stuff. We have hundreds of thousands of applications for the 2,000 to 3,000 we hire.
Your Bank of America is mostly focused in America, I assume, but do you have a lot of business outside, and do you want more business outside of the United States? Yeah,
we do business in 130 countries. We're in 30, 40 core countries. We've been in, like I said, in Japan for 80 years now, in India for 65 years, and Brazil since 1954, and Argentina since 1914. So we have an international business, and the amount of loans we have outside the United States for commercial customers exceeds what we have in the United States for large corporate customers. So we're a global business for global investors, global firms, private equity firms, global investors, global companies. And so we do investment banking, corporate banking, treasury, cash management, and trading across the world. And we're top 2 or 3 in the world in these businesses, going back to your earlier point, that the U.S. companies that come to dominate those businesses, and we're right at the top.
Were you ever at a cocktail party or a lunch and somebody gives you a resume? Does that ever happen to you, if somebody they think should be hired by the bank?
There's this thing called email that gets them there faster nowadays.
All right. And now, on the personal side, you've been there 15 years. You haven't announced any time when you might step back, and you're not prepared to announce that today, right?
No, I don't.
Okay. So
I'll tell you first, though, David.
Okay. So have you been able to convince your children to go in the banking world?
My oldest son's an investment banker for a different firm, obviously, and my middle child is a risk manager for another firm in financial services, and my younger's in communications and stuff. I never said, look, being a CEO's child is not the easiest thing, being a CEO's spouse. So they saw me work in different ways across the years, and so it's their decision what their career is, and it's nice. My son, he's a deal doer. He's an M&A type of guy, so it's fun because I used to do that. I haven't done that in a long time.
What do you do for rest and relaxation in all your spare time?
I do what everybody else does.
You're not
and that was David Rubenstein
anymore, right?
speaking with Bank of America Chief Executive Officer Brian Moynihan at the Economic Club of Washington. And you can watch more of that interview on the David Rubenstein Show, Peer-to-Peer Conversations, on March 12th at 9 p.m. in New York. I'm Sonali Basak alongside Katie Greifeld. You are watching Bloomberg Open Interest. Let's recalibrate here to the markets because, of course, we're less than a minute away from the opening bell. It's been a choppy trade this morning. Katie, what are you taking a look at?
Well, we saw that follow through to Friday's sell-off yesterday. There had been some optimism that we were going to be able to get off the mat, that those dip buyers would come in force. That didn't happen, Sonali, and you take a look at where we are this morning. We're trying on the S&P 500 to go green in the futures market. We were there briefly before the bell, but it looks like as we count down to the opening trade that it's going to be another volatile session. Of course, you've seen the reaction in the bond market to these growth fears just building and building. A big bid coming into the long end of the Treasury curve from the short end to the long end. That's not really giving a lot of solace to these equity bulls out there, because if the Fed has to cut rates because of slowing growth concerns, that's bad for equity markets too. But nevertheless, you take a look at the opening bells right now at the New York Stock Exchange, at the NASDAQ, no matter what the futures market is showing, we know that people will clap. And that's what we're seeing right now as we welcome in this Tuesday trading session. Just a couple seconds into the official start of this trading day, let's take a look at where we stand. The S&P 500, it's pretty much unchanged right now. As again, we're just a couple seconds into trading. That's not bad news necessarily when you think about the last few sessions that we've had. We do see a direction when it comes to big tech, though, and it's lower. The NASDAQ 100 currently off by about 0.2%. The small caps is a really interesting space right now. You can see the Russell 2000 really fighting to stay in positive territory, but this has been the biggest underperformer so far year to date. Even though we do have that big bond rally in the last couple of days, that should be good news for those small companies. But when you're worried about economic growth, maybe you don't want to be in the small caps. Meanwhile, we take a look under the hood here. Like I mentioned, tech stocks were sharply lower this morning before pairing some of those losses. Nvidia down at the moment, though. That's as the Trump team weighs harsher China chip controls. Palantir, also a company we've been keeping a close eye on. It's trying to break its 4-day losing streak. Doesn't look like it's going to do it right now. Currently off by about 0.9%. And then you take a look at Bitcoin. We have IBIT up here. That is the BlackRock Bitcoin ETF. Currently off by about 5.6% because not even Bitcoin has been able to sort of escape this risk-off mood, Sonali.
Do we want a silver lining?
Let's find it.
NVIDIA results are tomorrow, and perhaps this lowers the bar just a little bit. Maybe. Anyways, we're looking at Home Depot this morning. Results were out, of course, and we have the stock up about 0.9%, almost 1%. Sales rebounded last quarter as interest rates dropped and Americans spent more on home improvement. Comparable sales grew nearly 1% last quarter, and Wall Street analysts expected a 1.7% drop. Guidance for 2025 remains cautious. Flip up the board here. I also want to look, this one's for you also, Katie. We're looking at Hims and Hers. Brutal day this morning, down almost 22% as the market opens. Profit and revenue came in above analyst estimates, but it announced it'll stop selling some compound weight loss drugs, including semaglutide. That's following the end of an FDA shortage. We're going to bring you more on that later this hour. Let's take a step back from the single stocks. Let's talk about the broader market moves with Bloomberg's Jess Menton. After 3 straight days of declines on the S&P 500, we drop below that 6,000 level. Where are the dip buyers?
Well, it's important, too, because if you look at some of the latest retail dip buying data from Emma Wu at JP Morgan, it's interesting because yesterday, the first hour and a half, you saw retail traders actually selling more than $1 billion here worth of those stocks. If you're thinking about some of the most single names, Palantir, as well as Alibaba, some of the ones they sold. But as the session went through, you saw them coming back in, and instead of selling, they were buying some of those stocks, but still on a net basis, they were selling over about $1 billion worth of those stocks. But that's interesting because I was talking to you as well as Katie a couple weeks ago when it comes to some of the dip buying trends that have changed somewhat this year. Instead of seeing that on Mondays and Fridays, just because there's a lot of headlines coming out of Washington on tariffs over the weekends, as well as some of the news when it came to DeepSeek just a few weeks ago. We're starting to see retail traders step back in midweek, but still, nonetheless, you're still seeing some of the sentiment indicators when it comes to retail traders still around all-time highs, ladies.
Yeah, I made a lot of hay with that Friday stat yesterday. And I mean, the pattern held. Friday and Monday were both pretty ugly sessions. Let's talk about how people are positioning, especially when it comes to the volatility market. You're taking a look at the VIX right now. We're trading with a 19 handle. That's below previous spikes of volatility that we've seen. But when you consider the one-year average, still pretty elevated.
It is, and it's about 20% over that one-year average. It's also trading at the highest so far this year when you're looking at that. And I was looking at CFTC data. Obviously, this gets updated on Fridays around 3:30, just before the closing bell. But for 17 consecutive weeks here, we're seeing hedge funds as well as large speculators positioning positioning that basically they're expecting volatility to stay lower. The only thing, when we've seen different trends like that, say last summer, they ended up being caught wrong-footed whenever we had the unwinding of the carry trade. That's not to say something like that would happen right now, but the positioning based on the large speculators, they still think that volatility is going to remain lower from here.
All right, Jess Menton, always a master class. That is Bloomberg's Jess Menton. She covers equities for us at Bloomberg News. And let's keep this conversation going now with Barbara Ann Bernard. She is Wincrest Capital founder, CEO, and CIO. It's great to have you with us, Barbara Ann. So I want to talk about what's actually going on here. You have all these different theories as to what's driving markets down over the past couple days. Tariff concerns, growth concerns, maybe fears that we've reached peak AI in the U.S. What do you think is really the catalyst for these losses that we've seen?
Well, I think it's multifold. You're looking at peak concentration and very high valuations, so it doesn't take a lot to shake people out. And the trouble with how or what has worked in 23 and 24 is it was a lot of momentum trading. It was a lot of passive investing, which made the big bigger. And when you're not investing on the basis of fundamentals, it's easy to get shaken out, because if momentum reverses, what do? You sell. So you see Bitcoin down today, you see AI. And the reason is, if you think about the NASDAQ trading on 37 times future earnings, there's the risk that those future earnings get disrupted by technology itself, right? I don't think that's a safe investment. And then if you look at the S&P 500, it's struggling because the top stocks are so tech weighted today. And so what you're seeing is a shift out of the tech into free cash flow. And I think that's a very healthy thing for the market. And so I'm not excited about the index levels, but I am excited about the portfolios you can build if you're investing on the basis of fundamentals.
Speaking of portfolios, Katie made this great point yesterday that diversification is back, even if you believe the bond market is showing a bid because you're worried about growth and it's driving yields down. At least there's somewhere to go. But what I want to point out is you have a 10-year that is just above 430, and you have a market that's not significantly reacting to it. What's going to benefit if we do see rates decline? Or do you worry too much about growth to see that benefit from interest rates being lower across the curve?
So I think interest rates are declining, but I don't see a sharp cut so I think rates will stay. They're coming off a high base, but we're getting to a more normalized scenario. And that's what Brian Moynihan was talking about. He doesn't see rates cuts this year. So he believes his net interest margin will be fine. And if you look across the world, growth is slowing, which is all the more reason that you need to have solid business models, right? So I like companies that are utility-like with strong fundamentals and strong free cash flow. Bank of America is a good example. It trades at half the PE of the market with twice the dividend, right? And so when you talk about diversification, the biggest way to diversify is out of the US. That is the most expensive market right now, but that has been very unpopular until this year. And so you're seeing EM and you're seeing international outperform, and I expect that to continue. And so let me just break this down for you, because I can build a portfolio today that trades on half the PE of the S&P with 3 times the dividend yield and 4 times the free cash flow. And the reason that free cash flow is so important is the difference between a 1% and a 10% free cash flow yield is the ability to pay back the equity and bond investors all of their money in either 10 years if you have a 10% free cash flow yield, or 100 years if you have a 1% free cash flow yield. And the things that have been working are the growth stocks, right? The promise of free cash flow in 100 years. That's not going to work. So what is working is that beautiful little LBO candidate with good growth, good balance sheet, and the ability to pay back via dividends, via buybacks, and just conservative business models. So I can't control global growth, but I can control the stocks I pick.
That's a great point, that there are gems to be found. You just have to do a little bit of legwork. I want to stay international, though. I'm glad you brought that up, because it feels like one of the themes that has emerged in the past couple of weeks is this cracking, if you want to call it, of the America exceptionalism trade. And you take a look at the Citi Economic Surprise Index. It's actually flipped into negative territory for the first time in a while. And I'm wondering how much of this trade, this rotation into international stocks, is just that the American side of things is looking not too great relative to recent history versus actual fundamentals in other countries being strong. We had this conversation with Maria Waitman of State Street last week, and she said she doesn't think this is sustainable because it's not like European fundamentals are in a great place. I'm wondering how you're comparing the relative factors there.
So I wouldn't bet against America, right? It's a phenomenal country with phenomenal opportunity. What I would say is it's expensive today vis-a-vis the rest of the world. So my call is on valuation metrics alone. But Trump is running the U.S. like a company. That's really refreshing. I mean, and if you think about it, what the U.S. is undergoing right now is a restructuring. People and markets hate change. So if you look at the tariffs, he's just renegotiating his buyer and supplier contracts, right? If you look at what DOGE is doing, he's looking at the expenses and trying to trim the fat at the government level. Well, no one's ever accused the government of being run efficiently. That's probably a good thing. And then he's trying to increase his top line. You look at what Apple did with the reshoring of jobs and in America. Those are all good things. I think the U.S. is going to be stronger because of this, but it's that the market had such a run from the election to here that we have to grow into those multiples. And so you need to see earnings come forward. And you can't really do that in a quarter or two. This is a longer term, plan. So I'm underweight the US, but I'm not, I definitely want some exposure there and overweight emerging markets.
Speaking of valuation, I want to pull up here a chart of the S&P 500 versus what the Magnificent Seven have been doing, because you're looking at an S&P 500 that is about 2.5% or so off of its high, but the outperformance relative to the Mag 7 this year is pretty stunning. The Mag 7 has been quite a dog, frankly. At what point do you buy that dip?
You don't. I would short it. It's not done yet. If you look at the S&P in 23 and 24, X the Mag 7, the S&P was up 4% in 2023 and 6% in 2024, right? The only thing that worked in 23 and 24 was the Mag 7. That trade is over. Cash is king. Show me the money. Where's the free cash flow? I hope is not a strategy. And like I say, the tech companies, the biggest risk is that their earnings themselves get disrupted by new technology. That's what the DeepSeek threat was, right? You've already seen it. And I say it again, the problem with investing on a narrative or a theme or on the basis of fund flows is it's easy to get shaken out when when your fear surpasses your greed, right? If I have a stock and they're great fundamentals and it sells off, I buy more. If I have a stock that I've just bought because everyone else is, and it sells down, I need to hit that sell button and get out first, right? So it's a psychological thing. And I hate to say it, I mean, the way I invest has been out of fashion for the last 10 years. And I think a higher cost of capital is driving greater discipline in companies. And maybe this is the year where value investing is really rewarded and people who do the homework come out with a better result.
Barbara, we thank you for joining us today. That is Barbara Ann Bernard of Wincrest Capital. Back to the basics, Katie, is where we are headed. And
some fighting words, too, for the Magnificent Seven ahead of NVIDIA earnings. Excited to see how that plays out.
And as you've been pointing out, it's pretty close to correction territory. Maybe a little bit of investors waiting to see if we hit that point. Now, coming up, Hims and Hers plunging in the early trade while Novo rises. We're going to look at the weight loss drugs in the market next. This is Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, we have Walmart getting raised to a buy over at DZ Bank. That is despite that uncertain outlook from the discount retailer. Walmart's lower than expected profit forecast raising some concerns about the retail sector and consumer spending. Next up, Block no longer a sell over at Morgan Stanley. The firm is raising its view on the digital payments company in the wake of its results, which triggered, of course, quite a sell-off. And finally, Hims and Hers Health, no longer a buy over at Nephron Research. The company said that it will soon stop selling some compound weight loss drugs last night, and that move comes as Novo's Ozempic came off the U.S. drug shortage list on Friday. Let's get some more insight now into what's going on with Hims and Hers with Bloomberg Health reporter Madison Moeller. So, Madison, are they completely out of this business then? Because this has been quite a boon.
Yeah, so they are not completely out of the business of selling weight loss drugs. Hims is still expecting to continue selling personalized doses of Novo's Ozempic and Wegovy this year. What that means is they're basically going to tweak the dosage of these drugs to sell dosages that are not commercially available through Novo Nordisk. They're also planning to potentially tweak the formulation a bit by adding vitamins, things like that. We're seeing other companies doing that. They're also expecting to continue selling oral weight loss drugs, which are some older generic versions of weight loss drugs, and Novo Nordisk's Saxenda, a copycat version of that, which is an older weight loss shot that's a little bit less effective.
So is all of that enough to get them to their 2025 sales guidance? Because if you think about the math, I mean, they're expecting revenue to be between $2.3 billion to $2.4 billion this year. That is ahead of Wall Street expectations, and it feels like they're losing a pretty valuable chunk of their business here.
Yeah, that was, I think, the question that investors had last night, because they were trying to make the math work, as we were talking about earlier. And what Hims sort of has emphasized is that weight loss drugs actually aren't the biggest part of their business. Last year, they did $1.5 billion in sales. $1.2 billion of that was not from weight loss drugs. It was from their other offerings in erectile dysfunction, hair loss, skin care, dermatology, all of these different things. So they are trying to emphasize that they have this other businesses that are doing quite well, and that the loss of Novo Nordisk's some doses of their drugs won't affect them that much going forward.
And I'll point out, Sonali, that this stock has been on absolute fire. Through yesterday's close, up by about 112%. It's going to have a big bite taken out of it today, but still quite a run.
Yeah, and you have to wonder what's next for it after that kind of a drop-off. But I also want to go to Eli Lilly as well, because the news this morning that they are reducing the cost of certain vials to $50 less. I'm quite literally sitting in Matt Miller's seat. So I have to ask you how much price pressure there is in this industry, and should consumers be waiting till it's $100 less?
Yeah, it's a good question, and definitely a Matt question. But so Lilly is doing this in part to offer more accessible options to people who don't have insurance coverage for weight loss drugs, like people on Medicare, which still does not cover obesity drugs, period. And so what they're doing is they started offering these vials last year as a lower cost option. They're further reducing the price of that. They're saying is sort of in response to what they're hearing from patients and consumers, which is that even though they have this lower cost option, it's hard to compete with these compounded drugs that really cost even less than what Lilly's offering. So they're bringing down the price a little bit. They're also launching 2 new vial formulations, higher doses, so that people, because remember these drugs, you start at a low dose and you step up to higher strengths as you go. And so they're launching these additional formulations so that people have more options. And maybe it is worth waiting for the lower cost options, because they're coming.
All right, well, we'll make sure to pass that on to Matt. Great reporting, as always, Madison. That is Bloomberg's Madison Moeller. Now, coming up, the carry trade and the basis trade in the crosshairs of the world's top financial stability watchdog. Details next in our Wall Street Beat. This is Bloomberg. Welcome back to Open Interest. A quick check on markets, because we're now at session lows on the S&P 500, down about 0.4%. You can see that bond rally extending. 10-year Treasury yields down about 8 basis points, and the VIX now trading with a 20 handle. I do want to mention tech, though, because that's where a lot of this pain is being felt, with the Nasdaq 100 also off by about 0.9%. And officially, Sonali, the Bloomberg Magnificent 7 index extending its fall. We have hit 10% on that drawdown. That means we are officially in correction territory. So the pain obviously has been really in these big mega cap tech companies, and all eyes are on Jensen Huang taking the stage tomorrow.
Yeah, the market could really use him for a save. We've been wondering if that correction level would bring in the dip buyers, but momentum might not be on its side. Now it's time now for the Wall Street Beat. The Financial Stability Board, the world's top financial stability watchdog, is setting up a task force to identify areas where shadow banks could spark a broader crisis. They're focusing on high-risk areas such as the carry trade and the basis trade. Bloomberg's corporate finance czar, Neil Callahan, joins us from London. Neil, I want to just pull up a 1 year of the VIX. We're at 20 now, but some might remember last summer when it spiked significantly. I think it ended the day around 65, or it hit it intraday, but you could see just that moment where markets went haywire. It didn't get systemic at the time, but I would argue here that not just the carry trade had the ability to have broader effects. The basis trade with yields where they are there worries starting to come back to the market with bond market volatility starting to really upset the way hedge funds are operating in the space?
Yeah, absolutely. There's a growing concern about the amount of leverage in the system, particularly when you see these moments where everything seems to be okay. That it's at that time that often the unexpected happens, right? And when you have hedge funds borrowing at up to 50 times their asset value in order to invest in these trades, it doesn't take much for things to go wrong and that to have knock-on consequences for the financial stability and the financial system. And the FSB is obviously stepping up here and saying they're going to set up this task force to look at these trades with a view to ensuring that we don't have big blow-ups. People will obviously have memories of Archegos as well. Different thing, but it just shows how quickly problems in a small area of the market can become much bigger problems.
Neil, I think a lot of people forget in 2019, the Fed did have to intervene in this market when repo really blew out. They had to intervene again in 2020. Many argue that was COVID, but still there was a problem here with leverage. And it used to be that hedge funds would run 50 to 1 on leverage in this space. Could you argue that some of that running wild has been reined in anyways?
I think people are more conscious of it, and certainly once you tend to get a regulator view and regulator scrutiny, people tend to pull back. So the most recent data we've seen involves ESMA, which is the European Securities Agency, and what they found is that leverage is about 18 times on some of the trades. And that obviously is an indication that there's still very, very high leverage, but perhaps something of a pullback from what went before.
All right, Neil, great reporting. Appreciate your time. That is Bloomberg's Neil Callanan. Now, coming up in the next hour, I'm pleased to say we'll be joined by Nancy Tengler on these markets and this tech sell-off. Also by Blackstone's Joe Baratta, as well as Compass Diversified's CEO. All of that and more coming up. Don't go anywhere. This is Bloomberg. All right, we are 30 minutes into a pretty ugly trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is on assignment today.
And we're on tenterhooks right now when it comes to the S&P 500. When it comes to big tech as well, the S&P 500 currently lower by about 0.3%. That bond market rally extending right now, and it looks like we'll have another reason for it to do so with some consumer confidence figures coming out right now, Sonali.
Yeah, they're coming in light of expectations. Explains that bond market move. We're going to get right to the numbers and underneath the hood with Bloomberg's Michael McKee.
Yeah, we had negative reaction to Friday's Michigan numbers. The Conference Board number comes in even worse, 98.3 from 104.1, a significant drop there. You can see how both of those have turned around lately, and that's starting to worry people about what we might see in the future. The Conference Board expectations number falls to 72.9 from 83.9, and the present situation is the only thing that looks reasonably good here. It's at 136.5 from 134.3. So we're not seeing a lot of confidence in the economy, and I've got to look and see what they're saying here, basically. But they're noting that views of the labor market conditions weakened and customers became pessimistic about future business conditions and future income. They don't mention the word tariffs, which is the key word for the Michigan number, but it does seem to be a general feeling of malaise descending upon the United States. I note, and I don't know if you guys saw this, but overnight the Fed funds futures markets have priced in 2 full cuts this year.
Right. Haven't seen that in about 4 weeks, that full pricing.
Well, it is the lowest since the December Fed meeting.
Right, exactly. So let's talk about what this means for the Fed, because you take a look at the 2-year Treasury yield right now, extending its gains, yields dropping to about 4.09%. Feels like the Fed is in a pickle, because you think about this weakening consumer confidence that we're seeing, but you also think about the inflation expectation figures that we saw on Friday. That's a difficult needle to thread there.
Yeah, and you want to throw in the conference board ones. As I say, people don't pay a whole lot of attention to it because people don't give a kind of accurate answer. But right now they're expecting for a 1-year rate 6%. Inflation rate, which is significantly higher than what we are now and what we're likely to get to. But it does show that they're going in the same direction. They're showing inflation rising. So the Fed has to think about this, and what they're going to answer is we have to see more. More data. We see that consumers are feeling bad. We got a disappointing retail sales number, but Home Depot today came in with relatively good sales. So where is the consumer really? Friday we get the income and spending numbers, and that'll tell us a lot. And then they'll keep watching. We get the PCE numbers on Friday too.
Yeah.
And then we'll get CPI and such going forward.
All right, a lot to look forward to. Mike McKee, we'll see you again very soon. It's a tough time to be a policymaker. It's also a tough time to be a tech bull. Bank of America Chief Investment Strategist Michael Hartnett says that the emergence of China's DeepSeek has temporarily created a peak in the AI story. We spoke with him earlier today on Bloomberg Television from the Bank of America Investor Summit in Dubai.
Temporarily, DeepSeek, has basically caused a peak in that story. Okay. Because, if you think about, everyone is just all in on AI, but all in on US AI. And so you've got this story where, the concentration of the US market is such that you've got 7 stocks now, the Magnificent Seven, and they're worth $18 trillion. Suddenly DeepSeek comes along, it's like, well, wait a minute, we've got no Chinese. I think there's definitely rotation out of US tech into Chinese tech.
And if that depressed you, the good news is that joining us now is Nancy Tengler. She is Laffer Tengler, CEO and CIO. And in her latest note, Nancy says that she's overweight technology and disagrees that it's overspending on AI CapEx. Nancy, always a treat to have you with us. Talk us through your positioning here, why you remain overweight when you do have a lot of concerns out there that maybe we have peaked.
Yeah, no, thanks for having me, Katie. It's always great to be with you and Sonali and Matt when he's here. So I guess I would say a couple of things. The DeepSeek news wasn't new news when the announcement was made that they allegedly developed an AI model with inferencing capabilities for $5.6 million. Many had known about that. Meta had already set up a war room trying to figure out, what, if anything, they could learn from it. And I think many have come out in the U.S. and said, hey, this is great. The question remains, was it developed for $5.6 million? But we can debate that another time. But after that, all of the major hyperscalers, or all the hyperscalers, reported, and not only did they double down on their CapEx budgets, but Meta and Amazon increased their CapEx budget, which looks to be somewhere between $305 to $320 billion in spend this year. And then you add to the fact that our team, calls through all the earnings calls and develops themes. And what we're hearing is an increased number of use cases for AI. And now we're starting to see monetization. Add to that the CIO surveys are showing that while most chief technology officers believe that AI and large language models are important, only about 8 to 10% are spending their IT budgets on AI. So I think if you couple that with the backlog of demand that NVIDIA is seeing, with the spending that the hyperscalers are making eyes wide open, I think what we can say is that we're still in early innings, and that we should sit back and use this volatility, as we often do, to question our themes, and then also to determine if we want to add
Nancy,
to names, which is what we're doing this morning.
I so badly want to talk to you about artificial intelligence, but just before you got on air, we watched the Magnificent Seven head into correction territory, and it was led lower by none other this year than Tesla. Now, almost everything but Meta is in the red for the year, but Tesla's 23% decline really takes the brunt of that pain. The last time we spoke, just right after the election, you said that you'd get cautious on Tesla just a little bit right now. Do you buy the dip or do you stay cautious?
Yeah, I think we're going to be adding to holdings here pretty soon. I just kind of like to let it settle. It's really a story stock. And the story right now is not super favorable. But we've been through this before. We reinitiated our position when Elon was selling his shares and driving the price down to buy X. And so if you read his biography, as I have done, this is pretty typical. It's kind of a manic environment, and so we'll sit back. There's a lot that we like about the story, and I've talked about this with you multiple times. The Megapack business, which is the electric utility grade battery storage, I think it grew at over 100% last quarter and over 50%. I think it was 52% the previous quarter. We think there's a lot of growth there, and we've been talking about it for a couple of years now. So I think this is a stock you want to own for the long term. The reason it's not in our 12 best ideas portfolio is this very reason. It's a story stock. It carries a hefty valuation, and it's super volatile. But we do own it in our growth strategy.
And Nancy, you point out in your notes that you really hate talking about companies ahead of earnings, but that's exactly what I'm going to ask you about, specifically NVIDIA. Of course, it feels like the entire market is kind of hinging and waiting with bated breath to see what Jensen Huang says tomorrow after the bell. Obviously, NVIDIA has been in for a really rough ride. If we see that knee-jerk reaction to the downside, if people sell in reaction to that report, is that a dip that you would buy?
Absolutely. Yes. Thank you for asking the question, Katie. I loved what you said earlier, too, about the Fed being in a pickle. I think the market's in a pickle because there's a lot of cross currents. And yet, as Neil Dutta said on your air earlier this morning, I don't know why anybody's surprised about tariffs, and we've been saying the same thing. So I heard on a competing network today that the question, is the government going to force NVIDIA not to sell any chips at all? I mean, I think that's absurd. And so what we have to do as investors is step back and ask a couple of questions. First of all, the stock dipped below 100 in July when we added to holdings. And we added recently because we think that the earnings, it may disappoint on every level, not because the company doesn't beat and raise guidance, but because they don't do it as much as Wall Street expects. But there has only been one other time going into earnings where the stock is off, and that was in 2022. And then six or a month later, the stock's up 16%. So I think what we want to do is look for opportunities to add to holdings at cheaper prices. If it sells off, we'll be adding. If the stock runs, I think we're off to the races for a little bit longer.
One thing I find interesting, I was looking again at the consumer confidence data that dropped at the top of the hour. Not only is it weak, it is weak below every estimate out there. And if you have a consumer that is coming in this week and you have a NASDAQ and a Magnificent Seven really lagging the S&P 500 this year, how problematic is it that the consumer feels this way at this juncture for the broader market?
Yeah, well, there's two things in there, Sonali. First, remember the Mag 7 is not all of technology, and we think of it as such, but the names that we've been adding to are names like ServiceNow that is going to have an important role in inferencing and just AI, cloud computing in general. And that stock has given us an opportunity because during the earnings report, they've changed their pricing model from, not entirely, but at the margin, from subscription to consumption. And they think that's going to hockey stick their growth. We'll see. But on the consumer, two major research houses, Fundstrat and Strategas, have broken out the numbers based on Democrats versus Republicans. And the pessimism is coming from Democrats in the surveys. And so I think that's just important to keep note of because overall, if you look at how the consumer is spending, even if you look at Walmart's numbers, which I thought were pretty good, and apparently the company did too because they raised the dividend 13%, which is the largest increase in a decade. That's really what I pay attention to as an investor because that tells me what management's thinking. And what they said was all income cohorts were engaged and growing, and that the high income cohort was really dominating the growth at Walmart. So that's interesting on a whole bunch of levels. And so we're always concerned about the low end. But remember that everybody seems to be working at the moment. Now, we'll see. We'll see if that holds up. But we're not nearly as pessimistic as many of the headline readers.
Nancy, we thank you so much for your optimism as we sit at session lows. Clearly some dip buying opportunities. Nancy Tengler of Laffer Tengler, we appreciate your time. Katie, such an interesting trade today. I took a look at the S&P 500. The 4-day losing streak is the worst you've had since September.
Yeah, it's pretty ugly out there. You take a look at what is doing well. If you're looking for some bright spots, Walmart, like Nancy mentioned, of course, brutal reaction last week to their earnings, but they did increase the dividend, and you can see shares up about 2.6% today. That is one of your biggest contributors to the upside, along with Eli Lilly and Home Depot and Berkshire Hathaway. You're seeing some of these kind of consumerish names actually
value trades coming back. You gotta love
wild.
it.
Yeah.
Anyways, coming up, we're going to speak with Blackstone's most senior private equity deal maker, Joe Baratta, is joining us on set about what he sees in the pipeline. Stick with us for that conversation. This is Bloomberg. Despite a slow start to the year for IPOs, there is one large one, many large ones in the making, and one of them is tied to Blackstone. Blackstone is looking for a strong pickup in the IPO market, and Medline is one of the firms that they've backed, and it's expected to be one of the year's largest IPOs with a value of as much as $50 billion, according to Bloomberg's reporting. Joining us now, Joe Baratta, Blackstone Global Head of Private Equity Strategies. Is Medline the only one? I mean, when you look at the pipeline for what can come to market this year, what are the conditions that you're looking for?
Well, thank you guys very much for having me. I think the IPO market is looking for companies that are both large and unique, and they can't otherwise access in the public markets. And so I think there will be large private equity-owned companies that are special, that have great market positions, that can compound at high single digits, that really the public markets can't play. And I think public market investors, because of what's happening with the Mag 7 and as cash rates come down, they will be looking for other ways to make money. And I think IPOs will certainly be one of them.
You know, we were kind of laughing here. If you're a public market investor, you're looking at the VIX at 20 today, and you're not loving it. You're looking at volatility coming back to the market. It is higher than the one-year average. What does that look like from where you're sitting, and does it have the potential to close the IPO window?
Well, I mean, it's possible. I mean, the IPO market is a function of, where the markets are and investor optimism, enthusiasm. But I do believe that for really good businesses that are of large scale, that the public markets can't otherwise find a way to invest in, it will be open, and it's just a question of price levels. So we don't spend too much time thinking about market moves day to day. Fortunately, we're in the very long hold business. In a way, volatility is great for buying assets. As people get sort of concerned about short-term moves, we can have a much longer-term perspective, which is one of the great benefits of private equity.
Well, we watch markets second to second, so it's great to get your perspective here. I want to talk about IPOs versus M&A, because this is a conversation we have frequently on the show, sort of making the decision whether you exit via an IPO versus in an M&A sort of strategy. I mean, what does that conversation sound like?
Yeah. Well, corporate buyers are always, we always welcome them. I mean, if we're going to exit something, the most efficient way to do it is to a strategic buyer who has synergies, who has a need to own the asset. And what we have seen over the last few years is corporate buyers coming back into the M&A market through the uncertainty and the readjustment of cost of capital. And so I do expect the M&A market, particularly as we sort of get through a lot of the noise in the early days of the year, I think corporate M&A will come back pretty strong.
It's interesting because you have a number of interesting deals in the pipeline that have been completed. You sold the business to Novartis for more than $3 billion.
Yes.
You bought Jersey Mike's, near and dear to me. I'm a Jersey girl. You are too, Katie.
Indeed, yeah.
But what about the companies of the future? What are you looking for to put money to work?
Yeah, there are a few global mega themes that we can play across the whole of the Blackstone platform, from real estate and infrastructure through to all of our private equity strategies. One of them, of course, is the multi-decade global investment in computing power. And it's not just investing in data centers or power plants, it's the entire ecosystem that allows us to invest through our energy transition funds, through our corporate private equity funds, through our TAC Ops business, in the ecosystem of component manufacturing and service provision and technology and software, all related to the build out of computing power needed for AI and all the other things that everybody talks about.
So speaking of big global themes, to be determined whether this is a multi-decade one, but the emergence of protectionist trade policies. When you're thinking about different companies and their exposures, are you avoiding those that might be impacted by tariffs?
Yeah, I think there's a lot of tariff diplomacy happening. I mean, we'll see what actually gets implemented. Most of what we do isn't focused on businesses that are either importing raw materials to manufacture something or exporting products into this country, into these markets. If we were to look at a business, yeah, we'd have to consider the effect of tariffs and an increased cost of doing business for those companies, but that's not really our core focus.
Now, I want to point out that earlier this year, you got an expanded role, and it promoted a lot of people under you at the same time. And when I looked at the portfolio that you had assumed, it's not only $210 billion of assets, it's that a TAC ops business as well, and a business that I think is fascinating, the business of having more retail investors into your private equity business. Katie and I have been following kind of all of the knockoffs, frankly, in private equity being brought to market. What can you say about what can be offered to retail investors in the land of private equity? I know Jersey Mike's, for example, is a deal that retail investors have gotten access to.
Yeah. Well, I think at a high level, one should ask, like, why is there demand from retail investors for private equity done really well in the way that we and a few other firms can do it? And the answer is over 60% of the companies in America with over $250 million of revenue are in private hands. There is a very large investable universe in private markets that public market investors can't get. And of course, there's a lot of concentration in the public markets in a small number of very large cap stocks. So we are able to offer a big investable universe of high quality companies across the whole of Blackstone's platform, from a life sciences product development investment through to, say, Jersey Mike's. And basically what investors get from us is a heat map of virtually everything we're doing across the platform. And these are great companies, well managed, and I think it's a good complement to retail investors' equity portfolio.
Joe, we thank you so much for joining us here on set, middle of an interesting market environment and that long-anticipated comeback expected for the deals market. That is Joe Baratta of Blackstone. And you can watch more interviews like this. It's 1 week away. It's Bloomberg Invest live in New York, March 4th and 5th. Get a front row seat to conversations with Carlyle CEO Harvey Schwartz, Soros CEO Don Fitzpatrick of Soros Fund Management, Bridgewater CEO Nir Bardea, and of course Katie, me, and Matt, broadcasting live from the conference. Register your interest to attend at BloombergLive.com/invest. This is Bloomberg.
That was Welcome back to Open Interest. Let's get a check on these markets as the sell-off continues. You can see the S&P 500 now down by 1%, but it's big tech that we should be keeping an eye on. Of course, we're all waiting for NVIDIA earnings tomorrow. If we pull up the NASDAQ 100, you can really see that the brunt of the losses are in tech right now. We know that the Magnificent Seven, that index altogether fell into correction territory earlier today. Hopefully we can see tech, and there it is, down about 1.6% on the NASDAQ 100. You can see that volatility really in this market with the VIX higher by about 2 points right now. We are now trading with a 21 handle. We started this trading day with a 19, but obviously volatility moving higher as well. Let's take a look at the bond market quickly, because if you're looking for safety, you're going to find it in the U.S. Treasury market, with the 10-year Treasury yield currently lower by more than 10 basis points, nearing in on 11 basis points. That is no solace to the small caps, with the Russell 2000 down about 0.9% right now on those smaller companies, and Bitcoin also just an absolute wipeout, down almost 8%, firmly below $90,000 a coin. I remember when we were at 100. Much more markets coverage coming up. Stick with us. This is Bloomberg. maybe Berkshire's. There are holding companies that follow an investment process that's similar to Warren Buffett. They are on the rise. And one such company is Compass Diversified, which invests in middle market businesses. Joining us now, I'm pleased to say we have Elias Sabo. He is Compass Diversified CEO. And we're a few days removed from Berkshire Hathaway earnings. And really the story coming out of the Oracle of Omaha was that he's still looking for a deal. He's on the sidelines here. I take a look at the notes that you sent over to us. And you write that actually Compass Diversified is planning to be aggressive in this market in your capital deployment, pursuing acquisitions. Tell us where you're looking for the opportunity.
Sure. Good morning, and thank you for having me on. You know, we invest across our three verticals in consumer, niche industrial, technology, and also across healthcare services. You know, unfortunately, in the last few years, and I say years, not months, the M&A markets have been really moribund, and there hasn't been a lot of opportunities. We are starting to see a little bit of pickup. Unfortunately, some of the headline risk that's coming out right now, you know, has really started to cool that. Tariff impacts, what's happening with government programs right now. So the markets remain a little weak. I would say that on the industrial side, we're seeing a lot of opportunities now start to come around power generation, around things that can help with the grid because of the huge amount of electrical demand that's out there. But unfortunately, the M&A markets remain muted still.
Well, part of that also, I reckon, is because of the financing environment. One thing that has struck me is in the last month, you've had a spate of leveraged loan deals being pulled by the banks. You have investors, particularly CLO investors, pushing back, and then you have to look to the private markets instead. And even with rate cut expectations subsiding, rate cut expectations rising so that rates subside. You have two priced in right now. What does that mean about the availability of capital if you want to do a deal?
We're not seeing any limitation on availability of capital. There's been a number of years, and remember, our business is different in that we access all of our capital at the holding company, and we provide all of the capital that's necessary to do the transaction without third-party financing. It's already committed for us. So we're a little bit different than the traditional private equity space that relies on capital on a deal-by-deal basis. For the right company and the right opportunity where there's not too high a perceived risk, we see capital continuing to flow in. You know, with respect to our business, we did a $200 million term loan raise at the beginning of this year. It was well received by the marketplace. It added liquidity to our balance sheet to put us in place to be aggressive on new acquisitions that we're seeing. But we don't see the holdup right now being availability of capital for us or for the market broadly.
What if we continue to see a market environment like the one that we're in? We were talking about the implications it would have on the IPO landscape, but if we continue to get these growth scares just snowballing here and we start to see that being expressed more ferociously in these benchmark indexes in the Treasury market as well, I mean, does that have any flow through into the M&A market, or we are all just too excited about the regulatory relief?
It absolutely flows through. If you think about, you know, we are acquiring with an expectation of what the earnings are going to look for in the next 12, 24, and, you know, so on months forward. As we're starting to see real softening that's coming through, you know, all the macro numbers, whether it's retail sales, today's consumer confidence, that just shakes the confidence of a buyer in the forward earning profile of the company, and valuation expectations have to come down. So I think as a lot of these headline numbers come out, clearly we continue to wrestle with some of the macro, you know, government themes that are out there, whether it's tariffs, whether it's, you know, kind of DOGE projects, and whether that's going to reduce the amount of government stimulus that's coming into the economy. Those things all have a cooling effect, and we believe, you know, will dampen the expectation of buyers for future earnings growth and what one can pay, and that hurts M&A.
You know, you think about this growth scare that is increasingly being mentioned in the market. And Elias, when you look across your companies, Do you feel like you have to protect them from what might be seen through the course of this year? There's a lot of concern about weakening growth out there.
Yeah, we're starting to see growth weaken already. And we came into the year really strong. We have a proprietary index that we use called the Coty Momentum Index. We came in on the consumer side, it stayed relatively flat. It ended last year at 1.10. Anything over 1.0 is indicating growth. It's at 1.11 as of the most recent week. But if you add in our industrial portfolio, we've actually seen a material weakening. And, you know, the industrial economy, you see companies that act a little bit more quickly than the consumer. I think there's a lot of fear about government policies, and that's already starting to impact where orders are coming in. So we are absolutely starting to see the impact of, you know, this growth scare come into the numbers. And that impacts how we think about hiring, how we think about capital deployment, you know, new CapEx projects that we're looking at. Everybody becomes a little bit more tepid. And unfortunately, that is the snowball that kind of gets things to continue to slow. So we're taking a more conservative approach based on what we're seeing here in the first couple months unfold of 2025.
Would you be less interested in selling in this market? I mean, we're talking about the feed through into the M&A landscape, and we're talking about the appetite for you buying companies. But I take a look at, you know, some of your stats here. You IPO'd in 2006. You've completed 14 divestitures to date. Is this a market where you would be interested in exiting, or would you wait for maybe friendlier skies?
You know, in general, I think you want to wait for friendlier skies, but we have companies in our portfolio which are growing incredibly rapidly, have great defensibility around them, and in some cases, buyers see opportunity in all sorts of markets, and we're always open to transact. Right now, we do not look for any strategic divestments out of our business, so it's more opportunistic. So we're not looking to come to market to sell any of our companies. In fact, to the contrary, even though we see a little bit of slowing in some of this growth scare, we would much prefer to be a buyer right now. We think that as others are on the sideline because of some of these fears, that creates a great entry point. So we would rather be buyers than sellers today and wait for the markets to get a little bit healthier, wait for the outlook to turn a little bit more robust before entering to be a seller.
All right, it's a good place to leave it. Always appreciate you taking the time. That is Elias Sabo of Compass Diversified. Meanwhile, let's turn our attention back to these markets. We're just over an hour into the session and just seems to get worse. You're taking a look at shares of NVIDIA right now. This is your biggest weight on the S&P 500 ahead of the chip designer reporting earnings tomorrow. NVIDIA shares down about 3%. I also wanted to take a look at Tesla here because Tesla falling below $1 trillion in value with that 7% decline rate now. Just losses extending for Tesla. And you add it all together and you take a look at what's going on with the Magnificent Seven overall. As we've been talking about, we are officially in correction territory for the Magnificent Seven and then some. That 11% drawdown from its record high. This is a correction that really started in mid-December, and it's just been building and building as we get deeper into 2025, Sonali.
It's kind of like what we were talking about. We were watching that line at that 10% correction level, and momentum is drawing you down. We know there are dip buyers out there, but they're not showing up in mass.
I'd like to find one.
Right? Give us a call. Give us a call if you're buying this market. Anyways, we are also looking at where the haven bids are to the point you've been making. Really, all you can see is a bid in the 10-year and the bond market more generally. But you look across the board here, the drive down in yield is drawing the dollar down as well. And you did see the yen hit the greatest strength since October. As that dollar strength starts to wane as well, gold is taking a dip lower as well. I think that's fascinating in this market. I guess if you are worried about growth and if you're worried about stagflation is another big story to talk about now at this point.
The gold move is interesting because if I was worried about growth, if I was worried about inflation, I would probably be buying gold. But we know it's had a fantastic record-breaking run.
You worried about valuations when it comes to gold today, I guess. Brent crude is at 73. Looking at crude as well and crude futures well below $70. So there's your growth scare. We're going to talk more about it. But first, we're going to talk about Home Depot. Depot. Of course, single stock stories on the line here. They anticipate large home projects will continue to slow down. We're going to talk to Joe Feldman over at Telsey. He's going to join us next to explain why he is bullish on the stock. This is Bloomberg. And one stock we're following this morning is Home Depot. The home improvement giant is a hard-to-find winner in today's market. Joining us now, Joe Feldman, Telsey's senior research analyst and assistant director of research. He has an outperform rating on Home Depot with a $455 price target, $455. That is just over $50, maybe $60 from where we are right now. How do you get there? When you think about the interest rate story and the decline we're seeing at the long end of the curve, what's the correlation? Is there really good news baked into that for Home Depot?
Well, I think the good news that we're seeing is that the consumer is buying. And, you know, they had a very solid fourth quarter, and the underlying trends are definitely showing some life within the business. We heard from Floor & Decor last week, same kind of thing, where the trends are getting a little bit better. I think one of the concerns we all have is about mortgage rates and where they are. Home Depot and Floor & Decor now and others have started to talk much more about the consumer just having to adjust to the fact that we have higher mortgage rates. And once that kind of normalizes in the consumer's mind or the homeowner's mind, and that's where they're going to be selling or buying, I think that we could get some movement. So beyond that, you know, if people are staying in their homes longer, those with, you know, sub 4% mortgage rates, you're going to need to do some investment in the home. And they started to see a little bit of that, a little bit more life in sort of that repair activity. We really want to see that remodel activity kick in, and we're not quite there yet, but we're hoping it's going to come later this year.
Yeah, we'll see. A lot of people have their fingers crossed for lower rates so that they can get cheaper mortgages, lower rate mortgages. I might be among them, but that's a separate conversation. Joe, so talk to us, though, about the makeup of the typical Home Depot customer, because we talk about the DIY set, people doing it themselves, but I know that they've been trying to cater more towards the professionals who are doing that remodeling as well.
Yeah, and that's a great point, because the pro is like 40% of the business at Home Depot, and it does continue to grow. They remember made an acquisition last June of SRS, which is a pro-heavy business with roofing and other parts of the home, pool and other areas, and they've seen mid-single-digit growth in that business. The pro continues to outpace DIY growth. Pro backlogs continue to be pretty solid. The size of the projects may not be what they were 4 or 5 years ago, but the pro's busy. So there are projects happening. We just need to see those projects get larger in size. We also need to see the DIY customer, again, re-engage and start doing a little bit more work, larger scale projects. We're hopeful that we're going to have a good spring selling season. Remember, for the home improvement guys, spring is like their Christmas. So we're hoping we're going to see some of that start to kick in as the summer months get there.
We'll keep an eye on that thread. But Joe, it's great to have you with us because you cover such an interesting stable of companies. One of those companies is Walmart, which of course reported last week, and those results went over really poorly, I think it's safe to say. You're starting to see some life come back to that stock. I know that you have an outperform rating on the shares. What did you make of what we learned from Walmart and what the path forward actually is here?
You know, we thought Walmart sounded really good. And we had the view that probably 2-3 weeks from now, once we get a lot more retail earnings, we're going to look back and say, wow, Walmart was actually really good. And we wish everybody looked like Walmart. So, you know, the top line trends were very good. They're gaining market share across the board. They're seeing good improvements. Yes, they're investing in the business, but they're outpacing the investment of most everybody else in retail. And when you see, you know, when we had to adjust our numbers coming off of the Walmart earnings, we barely touched our sales number. You know, the street was kind of right there where the guidance they gave. It's really more about the investment spending. Where are the investment spending? It's happening in technology, supply chain, and AI related to help drive that and make efficiencies. You walk into a Walmart store today, not all, but some of the stores already have digital price tags in the grocery department. Can you imagine how much quicker it is? You press one button, all the prices change. That saves so much time and efficiency for Walmart, and it can allow the customers, the associates, to engage with the customers a bit more and help to drive sales. So we actually felt pretty good about what Walmart was saying.
Joe, I can understand how Walmart would be a little more immune to some of the issues in the broader economy, but you have consumer confidence data, according to the Conference Board, dropping by the most since 2021. Doesn't look pretty. You have inflation expectations also quite high. Who is most vulnerable in your universe to this?
Yeah, I think that the more discretionary you go, the more vulnerable you are. Again, back to Walmart. Walmart's actually really well positioned in that environment if there's more concerns. But I think that, as we go forward with, some of the more discretionary names, we have continued to see some pressure at the luxury end of things. We've been pleasantly surprised by home furnishing, starting to see a little bit of life there, kind of like the home improvement discussion we had, where you're seeing a little bit of comeback. But it's really, spending on those splurges where you're seeing some of the pressure. So I worry more about those types of retailers, like some of the specialty apparel, higher end, type of retailers.
All right, Joe, unfortunately, we have to leave it there. Hope to have you back again soon. Our big thanks to Joe Feldman of Telsey. This is Bloomberg. All right, welcome back to Open Interest. We're keeping track of this sell-off. The S&P 500 currently off by about 0.7%. We're a bit off of session lows. We hit 1% decline earlier today, but you can see coming back a little bit, but boy, it's still ugly out there. The NASDAQ 100, your big tech names leading the carnage right now, down about 1.3%. All the while, you do see the bond market rallying really across the curve here, which is interesting. Some of those rate cut bets coming into the market, supporting the short end of the curve, but you're also seeing a grab for duration here as those growth scares really pick up, Sonali. The 10-year Treasury yield currently off by 11 basis points.
Right, and some parts of the market are certainly hurting more than others. Joining us for more is Bloomberg's Alex Semenova, looking at hims and hers having its worst day ever.
Yeah, so that stock is really taking a hit. It's down 27% right now. This is after they said that they're pulling their compound GLP-1 drug off of the market, obviously really taking a hit on that news. And it's really interesting because we talk a lot about the AI theme driving markets. Obviously, last year, the GLP-1 weight loss drug story was a big one. So any company that is kind of reporting anything disappointing on that front is really, taking a hit.
Yeah, it's interesting. It feels like the GLP-1 story was the AI moment, but for healthcare. And now you're kind of seeing both unravel, at least when it comes to HIMSS. And there's a lot of fear about AI right now, whether we've reached peak AI. I assume you saw that Michael Hartnett interview on BTV.
Yeah, so he said that if we continue to see, this deterioration in the Magnificent Seven stocks, which, by the way, have entered a correction territory based on one of the equal weighted gauges of that group of stocks, he says that if we don't see that group continuing to make a recovery, if we don't see the S&P making new record highs at the same time that European stocks and Chinese stocks outperform, that could continue to erode confidence. You have to remember right now that we are kind of losing two of the key narratives of this bull market. The first is that investors have a friendly Federal Reserve at their back that is willing to cut interest rates. And the second, of course, is the AI story, first with the DeepSeek revelation this year, and then with some of these big tech companies not really monetizing on their heavy spending at this point on AI.
I gotta say, I'm really excited that we do have a Magnificent Seven index. It is really neat and a nice shorthand, but I don't like that it's equal weighted. I feel like that kind of takes some of the punch out of it.
Oh, I don't blame you for that. To your point, I enjoy looking at it every day, and that does take some of the bite out of it. I do want to ask you about broader sentiment, because we're sitting here, we've been talking about it all morning, that you have that index in correction territory for the Magnificent Seven. You have a lot of negative attitudes out there. You have an S&P 500, and this kills me. It can't hold 6 1,000.
Can't get off the mat.
Can't get off the mat. And so if you talk to strategists that came in all rosy this year, are they holding their targets?
Yeah, well, so far they are. What's really interesting is that through yesterday, the S&P has gone 36 straight sessions without back-to-back declines of 1%. So there is this view that dip buyers are still coming in anytime we get any kind of pullback. But there's also been very little conviction because even though people step in, we haven't seen the index make new highs. And at the same time, we entered the year with no really bears on Wall Street. Everyone kind of clustered around an S&P 500 target of around 6,500, 6,600, which was about a 10% gain, which is the average annualized return for the S&P. So everyone was kind of getting a little bit complacent, not really highlighting the risks that we're seeing right now. Everyone was excited about Trump's deregulation, tax cuts, but no one really pricing in this risk of tariffs and geopolitical tensions.
Yeah, which is funny because we knew that tariffs were going to happen. I feel like he was pretty clear about that. But you mentioned that everyone came in bullish, of course. For the last couple of years, they've come in bearish, as you've covered very well over at Bloomberg News, and now they're getting burned. But I want to go back to that Hartnett interview because it really made an impression on me, apparently. He said, this is Bank of America's Michael Hartnett, that people will look for a Trump move if the S&P 500 is between 5,600 and 5,700. Now, we're still pretty far away, but it is interesting. I mean, just
the Trump put.
Yeah, the Trump put, the Fed put, just in the last 30 seconds. Do people still believe in that?
Yeah, I mean, I had a conversation with Dubravko Lekos-Buhas going into this year, and he highlighted 3 puts, the Trump put, the Fed put, and the China put, and we're kind of getting none of those things at this moment. So we probably have to see stocks go a little bit lower before investors get comfortable stepping in at these valuations. It's important to note here, too, that we're coming off of 2 consecutive years of S&P returns eclipsing 20%. So we knew that this year gains wouldn't be as easy to come by.
Right.
BMO Capital Markets had a really good study of bull markets going back to 1950. They average about 6 years, and the third year tends to be kind of the toughest one, seeing single-digit returns. So this was kind of expected, this volatility that we're getting.
Well, we'll have to see what Jensen Wong has to say tomorrow. Our thanks, of course, to Alex Semenova of Bloomberg. And coming up tomorrow on Open Interest, I'm pleased to say we'll be joined by Anastasia Amoroso and Scott Cronert of Citi. This is Bloomberg.